Do you want to make sure that you have the best mortgage rate, both at closing and application time? Well, the difference between those two times could be costing you a lot of money. Today, I'm going to share with you some of the secrets that I learned in my 20 years with a major bank that's boosting their profits and could be costing you thousands. I'm Adam Walker, your friend in the mortgage business, and today we're going to dive into what's going on with fixed rate mortgages. And first, to understand that, we got to understand what influences fixed rate mortgages. So there's a couple of key factors here. A lot of times you hear the overnight rate and there's announcements that's coming out and there's set dates that those announcements come out. Those are for the overnight rate. What that influences is variable rates. So that's usually going to be the Bank of Canada has an overnight rate. The banks all have their prime rate, and you're given a discount below that prime rate. And as prime goes up and down throughout the term of your mortgage, you're going to have your rates are going to go up and down. That's a variable rate mortgage. Today, we're talking fixed. So what influences fixed rate mortgages? Well, it's the Bank of Canada bond yield, right? So this is for all fixed rate mortgages. There's a 5-year bond yield. There's a 3-year bond yield. And we need to understand that those can go up and down every single day. There's a lot of different charts. If you look it up, if you Google the Bank of Canada 5-year bond yield, you'll see where it's at today, and it'll give you the history of it. As the bond yields go up and down, so do the fixed rate mortgages. They don't change daily. It's not like fixed rates are going up and down every single day. There's different times of the year where we see, banks going where there's a lot more movement and rates are continuing to drop a little bit quicker. Sometimes we're in a lowering rate environment, a declining rate environment. Sometimes we're in a rising rate environment. So these bond rates, they fluctuate every single day. As a result, what the lenders do is they increase or decrease their fixed rates accordingly. So where's the difference between the banks and what we do as a lender? So as a mortgage broker, what we do is we offer what's called rate insurance. So we monitor the rates every single day, and we work with lenders that allow unlimited float downs. And that's important. Not all lenders give an unlimited float down. Some offer one time. You can float your rate down one time. Some offer two, and some offer none at all. In fact, we have clients, because of the lenders that we work with, where we've dropped their rate 5 times in the last 2 months, saving them almost a full percent. That's going to save them thousands of dollars over the term of their mortgage. Now, when it comes to the secrets that the banks don't want you to know, if you look at a bank, so if you Google any major bank and look at what is their posted rate, and we all know, yes, you get a posted rate and then you get a discounted rate. Why do they do that? Why would they advertise a posted rate of, something 3, 4, 5 times higher than what everybody else is doing? Well, it's important. What they do is they offer these posted rates. So let's use some round numbers. So let's say if today you Google your favorite major bank and they have a posted rate of 6%. They're going to offer you, when you walk into the sales desk, they offer you a rate of 4.5%. We're going to give you what's called discretionary pricing. And it's important to know that this discretionary pricing, the individual salesperson, whether it's with the bank or a mortgage specialist, whether you're walking in or the mobile mortgage specialist, their commission or their year-end bonus is tied directly to how much of that discretionary pricing that they give you. So it's in their best interest. They don't want to give you the best discretionary pricing. And this is important even through your application and through the term of your mortgage. And we're going to explain both why. So what the banks do is they give that discretionary pricing as the bond yields go up and down. So does their discretionary pricing. They'll tell you that, hey, don't worry. If rates come down, you'll get the lower rate, which is true. The downside is those rates, they rarely move. They usually keep that rate exactly where it is through a lot of the year. And what they change all the time is that discretionary pricing. You don't get any benefit from that discretionary pricing because they do what's called, you cannot reprice your pipeline. And even more, they have some sales that come out from time to time. So I remember the bank that I was at, we had a huge Black Friday sale. It was the first time a bank ever did a Black Friday sale on a mortgage. It was only for new applications. If you had already done your application and you already put your mortgage in, we couldn't do what was called repricing your pipeline. The banks don't want you to know this because it's going to cost you a lot of money. If they go back and reprice all their pipeline, you're going to get a lot of savings. That's why we work with lenders that allow us to reprice that pipeline, allow us to float down that mortgage through the entire term. Now, the other reason why this is important, that discretionary pricing piece is important, is during the term of your mortgage. So mortgages don't always last to maturity. A lot of times there's savings out there. If you take a rate up, let's say you take a higher rate and rates have come down, sometimes it's in your best interest to break that mortgage term and take a lower interest rate. Well, you will have to pay a penalty on there, and it's called IRD. So what that is interest rate differential. And it's going to be based on your rate at the time compared to today's rate, and they build a calculation out there. We can go through another video on what IRD is, but it's important to know that it goes by your rate at application and your rate today. They have that calculation and they come out with that number. With the banks, what they do, that IRD calculation, it's important to know, is your IRD calculation going to be based on your posted rate or your discounted rate? In a lot of cases, it's going to be on your discounted rate. And if there is an opportunity to save you money down the road, you're not able to do this. This is going to cost you thousands of dollars because you're using that higher rate of the two. With us, with all the lenders that we use, if we're doing an IRD penalty, you're using the actual payment that you're at, your contracted rate, we call it. You're getting your penalty based on that. If this interests you at all, if you're looking to save some money, give me a call. Don't leave money on the table. Let me help you secure the best rate, both at application time and at closing time. I promise, let's work together. We'll save you money. Even if you already have an approval in place with the bank, let me review it. Let's take a look at that approval. Does it say a posted rate and a discounted rate? If it does, we got to talk.